Good evening, ladies and gentlemen. Welcome to Business Today Television to our special episode of Market Masters. I'm Shailendra Bhatnagar, and with me, as always, is my colleague Sakshi Batra. We have a special guest for you today, a man who's extremely soft-spoken, but has a very, very strong command on the markets and is an extremely erudite gentleman. Ladies and gentlemen, please welcome Mr. Nilesh Shah. He's the MD for Kotak Mahindra Asset Management Company and a very well-known face, perhaps amongst the top three faces on Dalal Street. We are delighted to welcome Mr. Nilesh Shah to Market Masters episode, and we'll discuss with him how the flow is at the moment. But I'll just take 1 minute of your time to give you a background on Mr. Shah, and that will give you enough reason to find out why he is a special invitee today. So Mr. Shah is for the last 9 years working with Kotak Mahindra Asset Management Company, where he's the managing director. Before that, Nilesh ji spent somewhere like 4 years with Axis Capital. He's a very, very well-known stock picker, and he honed his stock picking skills at ICICI Pru Asset Management Company, where he was the CIO for 7 years. And prior to that, Mr. Shah is also the best known bond trader on Dalal Street. From 1997 to 2004, he spent 7 years with Franklin Templeton Asset Management Company. All told, 30 years of fabulous experience that will now flow in front of you as wisdom on Market Masters. Welcome, Nilesh ji, to Market Masters. A very warm welcome to you and festive greetings on this wonderful rally that's unfolding on Dalal Street.
Thank you, Shail Bhai. Wish you, your family, and every viewers of BTTV a very happy Diwali.
So we'll start with some tough questions, sir. And we've seen this dip in the US 10-year bond yield, as also in crude oil prices, and both of them put together have sparked this fresh momentum on Dalal Street. How do you see the global sentiment as far as equities is concerned, especially against the background of the conflict that is there in the Middle East?
So very recently we had interactions with a lot of global investors, and you can see a sense of envy in their eyes and words. They are almost believing as if India has some divine right to win. Just like our cricket team, albeit because of their hard work and excellent performance, is crushing opponents. Same thing seems to be happening in economy. We were worried about oil because of Middle Eastern conflict. Suddenly it has come down as US is relaxing sanctions on Venezuela, and they have more oil reserve than Saudi. They can ramp up their production over a medium term, and that will probably put a cap on oil prices for a long time to come. We were worried about US interest rates going into 5% plus territory. Suddenly US interest rates have come down. There was worry on monsoon, as in the month of August, we had high double-digit deficiency. Suddenly monsoons recovered in September and we had mid-single-digit deficiency. All our problems are getting diluted thanks to divine intervention. But there's no credit being taken away from the hard work put in by the government and Indians. When the world was spending money in COVID, we behaved more prudently. And today we are reaping the benefits of the same. In some sense, we are like an oasis in the global desert. Our problems are far smaller than what the world is facing, and our growth consequently is higher than what the world is seeing. In a very simple word, from being coaches or follower of global growth engine, global growth train, now we have become the engine. We are the leader of global growth train.
Wonderful. And this is a very welcome change over the last 30 years when, we've seen a lot of problems which have buffeted not only India's fiscal balance sheet, but also India's capital markets. Nilesh ji, we are at the cusp of the festival, and as you point out, there has been a Goldilocks kind of a scenario on the Lal Street. From this point onwards, we are faced with five state elections, as also the big one somewhere later in 2024. How do we navigate markets from now on? How do you see yourself allocating fresh equity at this point of time when monthly SIPs have hit 16,000 crore rupees in Indian equity funds?
So we have been by and large growth at reasonable price investors. By and large, we have bought quality stocks. Long back, one investor had taught me a golden rule. Nilesh, don't make those mistakes which I can commit myself. When I give money to you, I expect you to behave professionally. That advice has stayed with me. So we right now are looking on a longer term basis, not 1 year valuation, but 3 year, 5 year valuation. We are investing in real businesses which are available at reasonable prices and where we see a growth runway in terms of a trend. For example, we believe manufacturing in India is a longer term trend. People are diversifying out of China. They have many countries. India is one of them. And companies which can enter domestic market as well as export market and become part of global supply chain management, we think will be like pharma industry or tech industry of past. They'll deliver growth and profitability for years to come together. So basically buying quality at reasonable price wherever available.
Nilesh sir, happy Diwali to you, Sakshi this side. I wanted to begin by first understanding from you, for you as an investor who's been looking at the markets for the last 3 decades, particularly last 1 year, what is the biggest learning that you've picked up that you would advise investors to take with them in the new Samvat?
So one, Sakshi, which I have learned is that the flows can drive prices in the near term. And we have seen that over the last 1 year, a lot of flows have gone into small and mid cap. It has lifted their valuation. Today, large caps, when I last looked at, is trading at about 4% discount to their historical average, whereas small cap is trading at a 21% premium to their historical average. So flows can drive prices higher. Second, what I have realized is that in the market, we have to maintain our equilibrium. It makes sense to play contra rather than momentum. We have to buy looking at future performance, not looking at past performance. We have to buy not looking at one-way entry, but also exit. These are disciplines which will play out over a period of time. And today, when some of our funds are underperforming index, it's easy to go and explain to investors that this is my process, this is what I'm following, and people are fine with that.
Nileshji, if you look at the broader markets, this kind of a scenario is presented by itself in the private banking space. The frontline private banks are, of course, very quiet on the charts, but that's accompanied by a fabulous performance on the quarterly side, as also the demand for credit, which is growing fairly substantially. In your opinion, why aren't private banks outperforming the broader markets, given the strength that we've seen in their quarterly earnings fairly consistently?
So one, in the banking system, there is always a fresh supply coming as banks are capital intensive business. Number two, banks were widely owned by foreigners. And when they decided to trim their holding from October 21 to June 22, a large part of it was in banking. Even today, there is a churn going on from banking into PSU banks, into other sectors. But what we have to look at is not past, but the future. Are banks balance sheet healthy? Undoubtedly, yes. And इसमें एक छोटा सा किस्सा कहता हूँ. 6 months back, when SVB crisis erupted, a small bank in India, Shamrao Vittal Bank, had to announce that SVB is that American bank, the 16th largest American bank, which is going bankrupt, not us. Please don't line in front of us to take your deposits. This is the health of India's banking system, where the largest American bank is causing problem for our smallest bank. The NIMs are at all-time high level. Valuations have corrected reasonably. FPIs today have sold, but if they come back to buy India growth story, they'll have to buy the same shares at much higher prices. So we remain bullish on banks and financial services. And as long as there is aggressive selling, prices may remain depressed, but valuations are in your favor.
Nilesh sir, I'll also take one or two questions from our viewers list as well, and one of them has come in from New Delhi. Varun wants to know from you, sir, how can I ensure that my mutual fund investments are aligned with my financial goals, such as buying a house?
So Varun bhai, when you are buying house, whether it's near-term, medium-term, or long-term goal, that you have to take a call. If it's a near-term goal, in 6 months to 12 months you want to buy house, then please invest in short-dated funds, short-dated debt funds, like a money market fund, like a floating rate fund, like a short-term bond fund. If it's a medium-term, let's say between 3 to 5 years you want to buy a house, then you can look to invest in hybrid scheme, a balanced fund, a balanced advantage fund. Maybe on a 5-year basis, you can go and buy even a large cap equity fund. This fund you can held probably 1 year before the maturity, 1 year before you need money to buy house. At that point of time, switch them into debt fund. But if your house buying program is, let's say, 5-year plus, 7-year plus, 10-year plus, then please go into equity funds, a large cap fund, a large and mid cap fund, a focused fund. Those are the funds which would be appropriate for you if you want to buy a house over a period of 5 to 7 years.
Nilesh, at the moment there is a crisis of plenty as far as fund managers are concerned. There is a very, very huge inflow coming into mid caps and small cap funds. And given the mandate that fund managers have to invest at this point of time, there is this issue that valuations of large parts in this space have, are far above the 5 or 10 year averages. When you grapple with this kind of a crisis on a daily basis, how are you allocating funds or fresh funds in these two sectors, especially small caps?
So one shall buy, we are taking precaution on the liability side. We are advising investors that please moderate your return expectations. What you saw last year, 30% plus, is unlikely to be repeated next year. Second, please invest via SIP so that you are averaging into today's market. Third, please keep some cash to average down in case correction comes. This is not the time to be overweight equity. This is time to be neutral weight equity. Become overweight if there is correction in the market. Then the second risk management we are doing is on the asset side. As you correctly mentioned, small caps are at a premium to its historical average. So we are more moving towards quality stocks. We are more moving towards stocks which are still available at reasonable prices. For example, in banking and financial services sector, we are trying to stay away from landmines. For example, low floating stocks where valuations have become hugely expensive. So buying quality, buying reasonable price, these are the 2-3 characteristics which is ensuring that while we may underperform in the short term, over a period of time we will do well.
Okay, that's a fair suggestion in terms of keeping some spare cash just in case there is a sharp correction, and markets typically correct at a point when they are least expected. Well taken, Nilesh ji, in terms of averaging lower and keeping some spare cash for a bad day. Similarly, when you look at valuations in the mid cap IT space, for some reason they are defying gravity at a time when large cap IT is doing practically nothing. Since both of them address the same setup in terms of clients, how come valuations in mid cap IT are shooting through the roof?
So Shell, by again in IT sector, it is driven by what companies are doing on a bottom-up basis. Some of the mid-cap IT companies picked up some of the trends, for example, digitization, for example, security, for example, consulting. Some of them also picked up particular sector like CAD CAM design. Now, when you have specialization and when you are nimble, you are in a position to capture the trends much more correctly. It's like running a speedboat. You can take a U-turn very, very quickly. Large companies have become like oil tanker. If they have to take a U-turn, it's going to take time. And which is where we have seen that mid to small cap IT companies on a bottom-up basis have delivered better growth. They are forecasting better visibility of future. Their profitability is growing, even though margins are not comparable to large cap at a faster pace because of volume growth, and hence market is rewarding them. We believe large cap IT companies are probably 2 to 3 quarters away in terms of improving their guidance, in terms of registering better profitability growth with volume growth. And this will happen when they are able to crunch the sales cycle. This will happen when they're able to increase value add to customer by leveraging artificial intelligence or machine learning, or by providing value added services in consulting, digital ecosystem, security management, and so on and so forth. I think small and mid cap IT companies like Speedboat have taken sharp turns, but this large cap IT companies, as been oil tanker, are changing the course, and in a 2 to 3 quarters, they should be on the right path.
Okay. Nileshs sir, let's take one or two more questions from our viewers list. From Mumbai, Pratik Sena wants to know from you, which is the sector in the stock market that I should avoid over the next 3 to 5 years? And if I can also add to it, if you could also give us your view on the runaway sectors of this somewhat, defense, PSUs, railways, how will these perform over the next somewhat?
So Pratik bhai, if you avoid making mistakes, that is also a most important thing. So please stay away from promoters whom you don't trust, who have a track record of cheating minority shareholders. You should never invest in companies which are run by bad managers. If we take that as a principle, 90% of our mistakes will get avoided. So stay away from bad promoters who have taken minority shareholders for a ride, whose governance track record is not good. Now, what kind of sectors will do well over next 1 year? Well, it is always difficult to make that guess, because within sector there will be companies which will do well and companies which will not do well. Last year, who would have guessed that PSU banks will do well but not private bank? Mid-cap ITs will do well, but not large-cap IT. So my feeling is that when you are taking sectoral call, you'll have to still focus on the underlying companies, bottom-up basis, which companies, which management are, doing well. So within sector, focus on promoter, avoid bad guys, and stay with good guys. I think that should work well for you.
Absolutely. That's some very practical and advice full of wisdom when it comes to navigating the ups and downs of the market is concerned. Nileshji, let's take a hypothetical portfolio of 10 lakh rupees from a new investor who's just stepped into the Lal Street. Obviously, you will advise him to go via the mutual fund route simply because there is safety. How would you allocate those 10 lakh rupees over large caps, mid caps, small caps, maybe an international flavor, and maybe some debt? All to you.
So, Shailendra bhai, there's no one right size solution. Depending upon your size, you will wear different size of clothes. So, someone who is having no time, who is busy, I will recommend put your money into Kotak Multi-Asset Allocation Fund. Let the fund manager take the responsibility of your asset allocation between debt, equity, and gold. Now, if there is a conservative investor who is going to monitor his portfolio, her portfolio, I will recommend put 70% money in large cap equity fund and 30% money in large and mid cap equity fund. This is assuming that I'm only doing allocation for the equity portion. For an average risk taker, I will recommend 50% in large and mid cap fund and 50% or 25% in focused fund, which is 30 stock portfolio, and 25% in a mid cap fund. Someone who is risk taker, well, you can put 30% in mid cap fund, 30% in small cap fund, and balance 40% in thematic funds like banking and financial services, manufacturing, and 6 months down the line, technology. So there's no one standard solution. Give me your investment objective, give me your risk profile, then I can stitch a portfolio for you.
Okay. Nilesh sir, we've been looking at the long-term view for all the investors, but I also have to ask you, where do you see the Nifty by Diwali in the next year, in summer 2080, when we speak to you next year as well at the same time?
No, we'll speak to him many times.
So, I have always believed in quote of Warren Buffett, there is no one who can predict tomorrow. So all these predictions about where markets will be 1 year down the line are unlikely to be true. I have experienced myself that I have no ability to predict future and hence stop predicting long time back. If you are investing in equity, don't invest summer to summer. You invest for a longer period. हमारे यहाँ पे प्रथा है कि धनतेरस के दिन हम सोना घर पे लाते हैं. You don't buy sona for one summer to another summer. सोना घर पे ही रहता है. Do that with quality equity. Keep it at home. There is a tagline in a Swiss watch, Patek Philippe, that you merely pass it on to next generation. Yeah. Quality stocks are like that. You pass it on to next generation. Don't play summer to summer. Play generation to generation.
क्या बात है. वैसे let me just add a personal anecdote here. Over the last 27 years that I have had the pleasure of knowing Nilesh ji, it has been on 2 or 3 occasions where he has said that if you have one extra home, sell it and put that money in equities. It happened, I think, in 2013, definitely. I remember when we were facing the Chinese issue. It also happened in 2009. Then somewhere in 2016 also he said कि भाई एक extra घर हो तो वो पैसा आप बाजार में लगाएं, the returns would be substantial. The fact that Nilesh bhai, there is at least a 2-year wait for a Patek Philippe, and the starting price of a decent watch is 70 lakh rupees. My suggestion is that at this point of time, suggest a good fund which will be available for 5,000 rupees, and we can start it tomorrow morning.
So please consult your mutual fund distributor to find out what is most suitable.
हमारे तो आप ही हैं.
I recommend to everyone, please put money into multi-asset allocation fund. Let the fund manager take the responsibility of division between debt, equity, and gold. Over a period of time, multi-asset allocation fund should be able to deliver better return than 90% of investors who will generate on their own.
Okay, but again, Nileshji, you don't want to compare the fund manager of a multi-asset allocator fund to somebody in the general public who has little or no experience in picking equities. You would want to compare the fund manager with an equally professional peer in the segment where he is investing. My question to you is at this point of time, what is the fund manager of Kotak Multi Asset Allocation Fund doing in terms of allocating fresh money? Where is it going?
Sure. So we recently completed our largest ever NFO of multi-asset allocation fund, collected about 1 lakh applications. We were distributed by more than 8,000 partners. At this point of time, about 40% of the fund is invested into equity, primarily large cap and larger mid cap. About 25%, about 30% equity is invested into arbitrage so as to get equity fund status. That's more like a fixed income return. And balance 30% is divided, about 10% is between gold and silver, and about 20% is invested into debt securities, including margin for 30% arbitrage. So if you look at the ratio, we are somewhere around equal weight to equity. We are overweight to gold and silver, and we are overweight to duration or longer maturity in fixed income.
Okay, Nilesh sir, let's ask you one more question from our viewers list. Ravi Bhatia wants to know from you from Noida. He is it worth to go for a sip in a fund where NAV price is very high?
रवि भाई, फंड की एनएवी 1 रुपया हो, 10 रुपया हो, 100 रुपया हो, 1000 रुपया हो या 1 लाख रुपया हो, आप किसी में भी एसआईपी कर सकते हैं. एसआईपी रिटर्न्स विल हैव नो लिंकेज टू द एनएवी ऑफ द फंड. अगर फंड में सारे फंड में 10% रिटर्न छूटा तो 1 रुपए वाली एनएवी 1 रुपया 10 पैसा होगी और 1 लाख रुपए वाली एनएवी विल बिकम 1,10,000. एनएवी से फंड का परफॉर्मेंस कोई लिंकेज नहीं है, एनएवी से एसआईपी रिटर्न का कोई लिंकेज नहीं है.
क्या बात है. चलिए, आई एम श्योर Ravi has understood the basic underlying mathematics behind how an NAV rises. Nilesh ji, 3 years from now, should the present government dispensation continue, how do you see the markets reacting to that particular space, both in terms of how decisions are taken? The reason why I ask you, ladies and gentlemen, this question is that Nilesh is the first point of halt by any government in the center to understand how its policies are impacting the markets and how are the markets reacting to the changes or the reforms that the government makes. Your view for the next 3-4 years, Nilesh ji, should the present government continue?
I think market will have very, very high expectations from the government. They have built in 10 years infrastructure which was built before 2013. They have by and large put India in a comfortable position from an economic point of view. And I will say something which is so important for India. If you go to US, UK, Spain, Canada, in all those countries, they need to borrow $3.5 of debt to create $1 of GDP. Effectively, parents there are mortgaging future of their kids to ensure that their present is livable. You will be leaving more debt burden on your children than what you are carrying. At one point of time, US debt to GDP was about 50%. Today it is 125%. On the other hand, in India's case, we are almost borrowing debt as much as GDP growth we are creating. We are 1:1. We are the only major economy in the world which has reduced its total debt to GDP ratio between subprime crisis in 2008 to COVID crisis in 2022. we will look into the eyes of our kids and tell them that बेटा हमने आपका भविष्य गिरवी रख के हमारा वर्तमान नहीं सुधारा है. I don't think so. American parents or Canadian parents or UK parents will be able to say that to their kids. So there will be much, much higher expectations from this government to create inclusive growth, accelerated growth, and green growth.
Amazing, wonderfully sets up. Sir, since you were talking about the addition of thematic funds also for those risk takers, there's one question that's come in now from one of our investors watching us live from Noida. Sakshi Rawat wants to know from you, is investing in infrastructure funds a good idea given that the governments are constantly focused on infrastructure?
So, Sakshi ji, thematic funds are always high risk, high return fund. Sector rotation will always continue in market. And if you are a beginner investor, and don't take me wrong, but very few women participate in equity market or mutual funds compared to male, and hence I'm taking this assumption that you are a beginner investor. Then my recommendation is please focus on diversified funds first. Learn how those funds operate, how they go up and down, and then come to sectoral fund like infrastructure fund. You need to put a cap on how much you will invest into infrastructure fund. Infrastructure fund is like a desert. It cannot become your main course.
Absolutely. Thematic funds at best can be somewhere between 5 to 10% of your overall mutual fund portfolio, and even in times when you have a secular sectoral growth coming in, it's very dangerous to invest specifically into one thematic fund because you don't know how the sector is going to be 6 months down the line, and typically retail investors wake up post the crisis rather than before the crisis. Nilesh ji, the other thing that I wanted to understand is that over the last 6 months or so, defense as well as railway theme sort of dominated by very, very high budgetary allocations by the government of India have come up very smartly on the Lal Street. Is this a worry when you see stock prices going up 3-4 times already over the last 6 months, or are we at the beginning of a secular rally in these sectors given a bit of corrections that you just might see?
So, Shailendra, prices going up 3-4 times does not worry me if fundamentals have also grown. Today, in many of the defense and railway companies, floating stock is limited. It is controlled with the few hands, and hence valuations are higher, and hence prices have moved up. For those companies to deliver on those expectations to justify current valuation is going to be a very, very tall task. It's like expecting Maxwell to hit another double century in the next inning. Well, it is always possible, but it is very, very unlikely.
Right. Nilesh ji, with that, we'll call it a day. Thank you for spending so much of quality time with us and giving us such wonderful cricketing analogies to explain the intricacies of markets. Once again, the best of festive greetings to you, your family, all the unit holders at Kotak Mahindra Asset Management Company. May you always buy the best multi-baggers for them. This is the wish that Business Today gives to you. Thank you, sir, for your time.
Thank you, sir.
Thank you, Shailendra.
With that, ladies and gentlemen, we'll draw to a close on Market Masters. You were listening to one of the finest brains on the Lal Street, Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company. He oversees 74 funds over 3,50,000 crores rupees. Do stick on to Business Today for all your financial news needs. From me and Sakshi and the entire PCR team, thank you for watching.
Thank you. and welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is a special edition where our focus is on the Q2 earnings. The company on our radar is Lupin. The company has reported